here. And a very good morning to all of you. Can you please return my greeting? A very good morning, guys.
Very good evening.
Thank you so much. I'm so glad we have an audience who's alert and really interested in attending a wonderful session that is about to begin. So since I have your attention, can you please greet each other? Thank you. First of all, please give a very big round of applause for all of you. Thank you very much for coming here. I'm your MC for the day, Jagrati Mathur, and we are about to begin a very interesting session on global macro trends and 2023 outlook. But before we begin, I would like to welcome our chairman, sir, Mr. Ramki Subramanian. I would like to welcome our very esteemed speaker, Mr. Mohit Ralan. And we have very two special guests with us today from TIW Capital. Mr. Roy, right? Mr. Roy? Yeah, and Ms. Swansea. Thank you very much for attending the event, guys. And before we begin our event, there are some basic housekeeping announcements that I'd like to make. First, please keep your phones on mute at all times, and in case you have to leave the hall, please do so quietly without disturbing others. And kindly do not take your friends along with you. We have enough time to network afterwards. We have a lucky draw at the end of our session, thanks to our sponsor TIW Capital. So please drop your name cards in the bowl kept at the registration table to participate in the lucky draw. Please note that dinner would be served after the session, so you can enjoy networking and dinner with your friends later. Now, please allow me to go through the flow of events for the session. We will begin our event with a welcome address from our chairman, Sir Mr. Ramki Subramanian, followed by presentation from our esteemed speaker, Mr. Mohit Ralan. After his presentation, we would have a live Q&A session so that you can ask as many questions as you like from him, followed by a small felicitation of our speaker and lucky draw. We would end our event with a vote of thanks, and post that it's a lot of fun and frolic, so please stay. So let's begin our evening with a round of applause for our chairman, sir. May I please call upon Mr. Ramki Subramanian to present his welcome address.
Thank you, Jagrati. Good evening, ladies and gentlemen, friends. It's such a pleasure. Firstly, Happy New Year 2023. It's the first event for the year, and lovely to see all of you. I think the chapter has had an epic year, 2022. And thanks to all of you. A lot of them are not present here as well. A big thanks to all the members for making 2022 quite special in terms of number of events, in terms of both professional knowledge series, social events. There's been a pretty huge uptick in ramp up in terms of the member engagement and events last year, and we hope to continue that momentum into 2023. It's fair to say that 2022 has been one of the most uncertain years, lots of ups and downs, and the topic for the day, for the evening is quite apt. We're talking about global macros, we're talking about outlook for 2023, and we have an expert speaker, Mohit Ralan, who will take us through that. So looking forward to that, and welcome Mohit, and thank you for accepting our invitation. You must have seen the newsletter that was circulated earlier today. I hope that gives you a glimpse of a walk down memory lane, as they say, for last year. We'd love to hear your feedback and suggestions on what we can do, what we can add, what we can do differently. And I think if there's one thing I ask of all members is to please let us know about your skills and interest. And if we can share some of your expertise with fellow members, I think that is what the chapter is meant for, as a platform to firstly people to get to know you better, to understand your skills, your expertise, and how can you help fellow members. So I think one of the things we are trying to incorporate this year, in addition to events and various other things, is creating a database of members, professional background, skills, expertise, and what you wish to contribute. So some of you who've been a bit hesitant, I think this is the year we're going to seek you out. So seriously, I think it's important for us to mingle and help each other and make this chapter a truly vibrant melting pot. So that's one personal request I have for all of us. Why don't I also request Som to just brief us about the membership update, AGM, and a few other things. Somnath, our handsome young vice chairman, I'll just pass it on.
Thank you, Ramki. I'll keep my updates brief. I'll try to do so. I'll touch upon memberships, including renewals, because that's important in the beginning of the year. I'll touch upon website, then I'll touch upon a bit of governance, the election framework. So, in terms of membership, we're doing excellent. In the last couple of days, we have added many members, and thanks to our energetic membership team, many of them are sitting here. Thank you, guys. In terms of renewals, if any of us sitting here have not renewed the membership for 2023, I'll encourage you to do so ASAP. We have a QR code outside on the registration desk if you need so. Use that and then register for 2023, please. Just an update, I think in terms of total number of members, we are heading towards 450 mark now. Pretty close to that. Thank you. And renewal rate, surprisingly, we are only in the first 2 weeks of January, we are close to 50% renewal. So that's an excellent achievement for us. Well, in terms of website, we have launched the new website in December. And I hope that every one of us have already registered and logged into your accounts. If no, please do so. There's a separate login page for each of you. It's dedicated to yours, so you'll have your professional details, your personal details. And as we go, we plan to also introduce a few other features, which is when you register for events, it will have the history of events that you have attended. So we'll try to do those add-ins, etc., as we move forward during the year. So that's the website. Please do that. Number 3 on election framework. A bit of recap. Last year in AGM, we launched the new subcommittee, which is the election subcommittee. The purpose was to create an election framework which will guide us and which will assist us, in addition to the constitution, to conduct elections in a better way. The election subcommittee was, we have received many people's attention, not attention, I think interest, I'll say. So there were 11 people in the membership team, in the subcommittee team, sorry, my bad. There were 11 people in the election subcommittee team, and during the last 5-6 months, we have gone through all the clauses which are related to elections in our constitution. We have also used 2 other documents. One is recommendations from ICAI India for foreign chapters, and the second one is governance for better governance for the societies in Singapore. There's a document that Singapore Societies Act have released. So we have used those 2, used them, and tried to come out with recommendations which are in line with the chapter's constitution, but also make the process more, I'll say, solid or foolproof. That set of recommendations is complete and have been sent to the management committee as we speak today. The committee is reviewing it, and we hope to send the reviewed and approved set of recommendations to everyone, to all our members, 30 days before the AGM. Now that brings me to the topic of AGM, which is we are planning to do the AGM in April. We will announce the dates very soon. In terms of events flow, after this, we look forward to one event in February, 6th of February. We are doing an IPV, which is the Inflection Point Ventures. This is a venture capitalist
Startup ecosystem.
They'll cover the startup ecosystem in India. They are quite popular because I think some of the founders of IPV are from SRCC background, and they're quite popular in Singapore space as well. So we're doing that on February 6th. February 12th, we have a family day, which is again a social event. Families are invited as well. After that, we'll do some events in March. A couple of them in plan. Let us finalize those, then we'll share more details. And then we'll go into AGM in April. So that's pretty much of the update from my side. Thank you.
Just a quick one before we invite the speaker. We do have the honor and privilege of having a senior member from ICAI India, from Solapur, Maharashtra, CA Birazdar, who has been a qualified member for 45 years. So please do give a warm welcome.
Thank you, sir. A happy new year to all of Singaporeans, my professional colleagues, and all the members. Mr. C. A. Ramki, Chairman of the chapter, C. A. Adak, C. A. Surana, and C. A. Shroff, and all other colleagues. You have given opportunity to talk to me 1 minute. So I share my experiences. So since 1977, I am practicing at Solapur, Maharashtra. Now just 20 years back, we have prepared a partnership firm. Because of the Mofussil area, all non-corporate work, trust work, audit, taxation, we are expertise in that. Then myself is having surveyor and loss assessor license since 1980. So I am doing that business also, insurance assessment, loss assessment. Then regarding a social aspect, so I am a cooperative bank ex-director. Then in education institution, architecture college, we all my friends were running at Solapur. Since last 30 years I am trustee. One Gnan Prabodhini Trust, basically at Pune, but it is having a branch at Solapur also. There also I am trustee. My sons and daughters have learned in that education. Then my son-in-law is in Singapore. That's why I came to meet my grandchildren, and I am here for you. All the best wishes for the new team, old team, and whatever I have seen in the website. I have read all activities. It is wonderfully done. Socially, it is for professionals and industrialists also. And with today's speaker, I think that you will get good fruits from him and you will enjoy the talk. Thank you, sir.
Thank you so much. Back to you.
Thank you so much, sir, that you came here from Solapur. And thank you so much, Ramki sir and Somnath. Under your leadership, I think our chapter is growing manifold. So huge congratulations to you guys. Okay, so global trends, macroeconomics. This is quite heavyweight, right? But so relevant in our current time. We all see that there are so many global economic, geopolitical changes that are happening. The scenario is changing rapidly. We have war, we have recession, we have inflationary trends, we have rise in interest rates and whatnot. All these changes across are impacting every industry and different aspects of our lives. And thus, the need to understand and foresee the changes in this changing geopolitical scenario is of prime importance to us chartered accountants especially, because we all play a very crucial role in managing finances across industries. So in order to give us a deeper understanding on these trends, we have an expert amongst us today, Mr. Mohit Ralan. Guys, please give a round of applause to Mr. Mr. Mohit has a very affluent career, I must say. He is the CEO of TIW Capital Group. He has a professional career spanning across 2 decades, 6 funds, and multiple businesses. He invested circa SGD 250 million in companies with specialization and margin expansion and turnaround situation with 0% loss ratio at fund level on principal amount. Wow. He had demonstrated repeated success in investment judgment, fund management, portfolio management, and business strategy. Exceptional communication, presentation, and mentoring skills with distinguished abilities in leading teams for developing service standards for investment outcomes. Based in Singapore, Mr. Ralan is currently managing circa SGD 250 million AUM with multi-assets, multi-geography buyout, and fixed return funds with an investor spread across 28 countries. Prior to TCG, he was an investment and operating professional at Baring Private Equity Partners Fund 2 and Fund 3. Baring had an AUM circa of $1 billion US. In a career spanning 2 decades, he invested and guided companies across multiple sectors. Served on the advisory board of companies in the interest rate sensitive sectors, FMCG, technology, education, consumption, media, digital business, real estate, and manufacturing consumption. Mr. Ralan is a regular speaker, moderator in various industry forums. He has been awarded by the Times Group as the most promising business leaders of Asia. Huge congratulations, sir. For the year 2019 and 2020. Mr. Ralan has recently been awarded by the Global Brands magazine, the United Kingdom, as the most innovative leader, Investment Solutions Asia for the year 2022. So may we please have Mr. Ralan to present his views on the global changing trends. Over to you, sir.
Good evening, everyone, ladies and gentlemen. Welcome to the new year 2023. Well, last year has been extremely turbulent. I don't think so it was a bear market. I don't think so it was a bull market. What do I really mean? Everything came down, right? It's one of those rare years where in few cases a century-old records were also broken. Germany PPI at 45%. Why is it relevant? Because it's the second manufacturing hub of the planet. US CPI 9.1. $33 trillion lost in market capitalization globally. As I understand, in Singapore we manage $5 trillion of asset under management. And the total market cap erosion of FANG stocks was $5 trillion. Last year, FANG stocks lost $5 trillion. I can go on and on. The worst ever performance of US 30-year bond ever in a single year. Very rarely you'll see almost everything falling. And that was 2022. So what's in store for 2023? Well, I can say one thing. In June of 2021, when we launched our bear market product, and I say with pride and humility the bear market product because it was a fixed return product, we projected, and some of the ICI forums globally have spoken in the last 18 months, and we projected a 4.5% yield in US bond market. And I'm sure people must have laughed at that time because Guggenheim Partners equivalent were talking negative interest rates in 2022. Unfortunately, we were right. I say unfortunately because the general wealth erosion globally has been unprecedented. So I'm going to be brave, and I guess I'm the guinea pig because it's the beginning of the year and first trends of 2023 I'm supposed to speak on. But a lot of our investment hypotheses are linked to this. So I'm going to try and be brave and talk about 2023. When we meet again in 2024, you can advise me how many of these went right and how many of these went wrong. Okay, a recap. So I'm going to start with a recap of 2022. Context is extremely important. Am I audible?
Yes.
It was a turbulent year and significant macroeconomic events mandated a very different paradigm. So what happened? Post-COVID 2020 crisis, there was massive liquidity injection by central banks globally. Now, not only that led to a pent-up demand because too much money came into hands of consumers at large, but there was something very specific which happened. Labor shortage. My favorite issue for the last 18 months was labor shortage. Reason is, any idea what is the biggest paradox of human life? Forget money for a minute. The biggest paradox, anyone?
Having productive work.
Fair?
Job loss.
Job loss? Aging. Do we agree? We haven't conquered it yet. You can decide when to be born, but aging is not yet conquered. Mr. Musk is trying to replicate his brain into a floppy and make sure mankind is extinct, if that happens, right? But the biggest paradox is aging. So what happened is, what COVID led to, The biggest paradox of aging always led to a shortage of labor, because when I joined as an analyst 25 years back, I was nobody. And then we grow and become CEOs and seniors in organizations. And one fine day we retire and wisdom moves on. But beyond that, what COVID did, it led to significant labor shortage because of health issues, reduced incentivization to work, doles being given by Western economies, right? Vaccination. United States of America, 70 to 73% population is vaccinated. That's it. So while there are a lot of people who are competent to work, they are not authorized to work. All of that supply shock, all put together, led to a significant challenge of labor shortage. Now people talk about inflation. Why we were so sure? Nobody anticipated Ukraine, neither do we, we didn't. However, wages, you're all in part of large organizations or running your own businesses. Have you ever decided that, okay, this year we will reduce wages by -10? Forget recession. We're not used to, right? Because once wages increase, they increase forever. And hence the persistency of inflation, that is wage hike linked, tends to be phenomenal. On top of it, in the last 100 years, the number one economy and number two economy, one thing was common, number one was common, right? Number two kept changing. Germany, Japan, UK, China. I'm going to give you a very interesting data point on China. Manufacturing hub of the planet, right? We all know. Any idea what's the saving rates in United States of America? Any guesses? Wild guesses, please?
Negative.
Okay, good one. Very close, man. Mike, you're very close. It's as is 2.9% odd. However, in general, 5 to 7%. You know, among large countries, large means 100 billion GDP and above. Which country has the highest saving rates? Any guesses?
China.
Singapore. Paradoxical, right? Cost of living is high. Singapore is the highest saving rate in the world because healthcare, education, housing taken care, and taxes not as high as Scandinavian countries. It's a no-brainer. It is. But China, somebody said China, it's 40% plus, 40, 50% saving rate in Singapore. China is 40% plus. Basically, at 17, 18 trillion, Chinese are saving $7 to $8 trillion annually compared to $500 billion in the United States. Please understand the context. So while we all talk about GDPs, I think what matters is these savings, right? So $7 to $8 trillion of savings in China compared to 0.5 trillion in US. Now see number one and number two in that context. So all of that led to obviously demand being higher than supply and high inflation, no brainer. What happened is essentially while all of this in the last 100 years led to a recession, in one of the recessions in the last 100 years, in 2022, all of them converged. So you had obviously supply shock in 2022. No, there was a supply shock in 1940s. Who's talking about it? You know, post-COVID there was pent-up demand. Post-World War II there was pent-up demand. Currently there is mistrust across nations. Post-World War II there was mistrust across nations. That led to a supply shock, double-digit inflation. However, the banks acted extremely smart. Until recently, I felt one country was being reasonably smart, Japan. They were not increasing interest rates and they gave it, finally. Right? In late 1940s, US Fed did not increase interest rates. In spite of double-digit inflation, they just reduced money supply. Whenever money supply is reduced, there is technical recession, 2-3 quarters issue, but that led to a significant basing of multi-decade growth on this planet, baby boomers to start with, so-called in the 1960s in US. And of course that followed with Margaret Thatcher days in UK, followed by Japs in 80s, then South Korea, then China, then many other countries now. Long story short, it's a tsunami of issues that happen. Now, to understand likely impact of current risks, let me time travel and take you back 100 years. And I'm going to talk about a case study 100 years back. Wonderful. So basically, in 1920, there was Spanish flu. Stock markets went up 500% after that. Why was everyone surprised when markets went up in 2020? It happened 100 years back. However, there were three things different now compared to 1920. Everyone said that it's doomsday, but there were three things different. We have done a lot of investments in healthcare, and including drug discovery. I can tell you there are three basic things different in 2020, and for any viral disease in the next 100 years, that difference will continue. Number one, there was no vaccine in 1920. People don't die because of virus. Virus is not supposed to kill actually. I don't know if you know that. They're supposed to coexist. And stupid virus like Nipah and Ebola, Nipah virus and Ebola, why they are stupid? Because they kill too fast. COVID was an intelligent virus. It didn't kill fast. Asymptomatic spread, right? But the important point is, it is secondary infections which kill. So there was no vaccine. There was a vaccine. There was no DNA mapping. There's a DNA mapping. And there was no penicillin. There's penicillin. Long story short, it led to pent-up demand, but with a supply shock because of zero COVID policy in the largest manufacturing hub of the planet. What Ukraine did, it damaged the second largest manufacturing hub, which is Germany. So what happened is, US Fed was not happy about it. Well, every recession on the planet has been driven by United States Federal Reserve. Pun is intended, but it's a fact. So what did they do? They increased interest rates extremely fast in a matter of no time, exactly like 2022. They increased interest rates by 2x. The difference is in 2022, they did it by 8x. Have you heard of Jackson Hole? It's a kitty party of central bankers, right? 2021, in Jackson Hole Symposium, Mr. Powell made a mistake, two mistakes rather, along in using the word mistake. One, inflation is transitory. Second, labor shortage is transitory. He was wrong on both counts. So 2022 is redemption time. So two, again statements. One, monetary policy is going to be restrictive for a long time. Nobody wants to believe that. Every time he shouts and says, but people want to not believe. And second, there's going to be pain. Please go through the Jackson Hole video. It's just 8-9 minutes, of which only 2 minutes is relevant. There's going to be pain. This is the most dangerous statement he said. Why? Because the manifestation of pain is not recession, it's job losses. Job losses lead to pain. And that is where it's a very paradoxical situation, because the logic of a welfare state, whether monarchy or democracy, is welfare, and welfare is defined with low unemployment. But the stated goal of United States Federal Reserve, repeated if you look at their articles, is to take the unemployment up. That's paradoxical, right? Do you think in our part of the world people can survive? Politicians, if they say unemployment will go up? That's US for you. But they did something else. They decreased money supply by 31%. You know money multiplier, right? 8 times its impact. $92 billion withdrawal every month by United States Federal Reserve. That's why dollar index is where it is. $92 billion a month. Look at the multiplier, right? Long story short, this led to basically a 90% reduction in Dow Jones. Well, that was intended. Please note, because they were not happy with the speculation. However, the bazookas, why do I call the bazookas? Because what comes out of a bazooka is unintended or unwanted. The bazookas, long story short, because of time I want to keep it simple, destruction of aggregate demand. And that's what is the core purpose of the policies in Western context and developed countries today. They want to destroy demand, because if you can't manage supply, it's not in their control, right? Ukraine is not in their control, and COVID policy in China is not in their control. Destroy demand. And that's why they keep increasing interest rates. And the best way to do that is to increase unemployment, and they are failing in that. Kindly note, they're failing. Today, while I'm speaking, I'm sure data is going to come out. Forget CPI, that's not important anymore. It will be less, doesn't matter. Unemployment, that's the key for 2023. If you want to track your investment portfolio, just track the unemployment rate. If unemployment rate is going up, negative correlation to your portfolio value, and if unemployment rate is going down, that means no recession. So just track the early warning signal, just track US unemployment rate. That's it. Nothing else. Forget the clutter. Well, so summary 1929/2022, this is what they did. I don't know why people talk about 1970s. It was very different. What they're doing right now is very similar to 1929 and 1930s. Mind you, these policies were the genesis of World War II. The protectionism that happened basis 1929 to 1935 was the genesis of World War II. Just as a point. Okay, what's the possibility now? We have seen the issues 2023 to 2028. Disruption in supply chain, it's eased out. If you look at the chart, clearly it has eased out. If you look at, it's still, however, higher than the pre-pandemic level. But with China's policies, easing out, one expects supply disruption to reduce dramatically in 2023. So that's the first key macro trend, that with the improvement in the sentiments in China, the disruption in supply chain is going to reduce dramatically. Increase reduction in Singapore, deglobalization in US, localization trend across the world, anti-vaccine activism in developed markets, countries like Norway saying no to a fourth dose. Any of you have traveled to Africa ever? Anyone? Yellow fever shot? 1 in 1 million people die because of yellow fever. So this led to a massive labor shortage, wage hikes, and they still continue. People were so elated last week. 0.3% increase in wage hike, expectation was 0.4. I was in London 2 months back, 2.5 months just before Truss became PM for 45 days odd. Interestingly, the inflation data came at 9.2 and people were elated. I said 9.2%? You expecting 10 and you got 9.2 and you're happy about it? Our tolerance levels are so high. Please note, developed markets have never learned the art of handling high inflation. This is very important to understand, right? Now, this is where the issue is. 55% of world GDP. I've just for effect shown Germany, France, but that's EU, because some of the other countries are even ridiculous, 20%, 25%, I'm talking European countries. Can you imagine this level of inflation? Right? So, while it is easing, it is still high. There were 3 wars which were going on last year. 3 wars. Not just Russia, not just COVID, Cold War. Yeah, between China and US. No, between EU and US. How many of you know there's a Cold War between EU and US? Anybody? Inflation Reduction Act. Please read about it. Which part of the planet impacts the most? Auto sector of Europe. They're quite cheesed with the United States. There's a general Cold War. We are just living in perceptions. The Inflation Reduction Act of United States impacts the auto sector, which is one of the major employers in Europe, Eurozone, dramatically. Well, you know the rates, how they have grown. Most interestingly, 18 months back, I spoke about 6.5% mortgage rates in US. People smiled. I was wrong, it went to 7. Can you imagine 7%? And we have a Bahrain desk as well. We have offices in Bahrain and some parts of Middle East. And we have a lot of Bahrainis who are investors. And one of them is in the Shura Council. Like we have our parliament, right? And he's an economist. And I said, you have the currency which is pegged. Why are you increasing interest rates? I mean, your mortgage rates. I said, because you're pegged. But I said, but Europe has euro, but they have a separate fiscal policy for each country. Why can't you have a separate, currency pegging is fine, but why would you increase mortgage rates? They're having 6-7% mortgage rates in Middle East. Is that a joke? So, This is going to lead to significant challenge for real assets in coming 12 months. Okay, quantitative tightening. We all heard quantitative easing, and there is a massive quantitative tightening which still continues. It's a significant reduction of balance sheet which is still continuing, and that's not a joke. It is bizarre because there's a money multiplier effect to it. When $1 is printed, $8 goes as lending, Basel norms. What happens when reverse happens? Dramatic, right? So, long story short, multiple causes and high complexity that defined 2022, and majority of those causes, while they have moderated, so we are looking better, but they haven't gone. So this is an extremely important context to understand. Well, with this background, the fact is inflation is nicely placed. Some factors taking it up, some factors taking it out. However, the biggest factor, the biggest component of inflation which people don't understand is shelters, rentals. And rentals have a 12-month rolling cycle. Once you lock in, you know how much is the increase in rent in Singapore? Bizarre. I suffer. Right? So rentals, that's the big component, and it's a 12-month cycle. So the impact takes time to get redressed. So that's on inflation. Now I'm moving towards 2023 basically, right? But I wanted to share the context so that, light doesn't switch from 31st December to 1st Jan, right? The value of items continue to be the same in cold stores. If you have to look at 2023, and if you have to ask me one parameter, Mohit, that one we should look at during the year for you to evaluate impact on your portfolios, your clients' portfolios, if you're gatekeepers, families, it's unemployment rate in the United States of America. This is the key factor which will determine the direction of the asset classes. Logic, nobody's talking about earning contraction in 2023. We anticipate a massive earning contraction in S&P 500 to the extent that we expect around $195 to $200 for 2023. I'll show you a chart. I'll not mention now, but I'll show you a chart of last 140 years average price to earning of S&P 500. If 195 happens, if you take the average of 140 years, what is the number? I'm not saying it goes there. I'm just asking you to do the maths, and I'll show that chart in some time. So, very important point is unemployment rate. It's not going up. They are frustrated. It's not going up. Any idea what's the average unemployment rate for last 50 years in US? 6.2%. 3.5% was the number till 6 months back, and it's 3.7 as we speak. So they are not happy about it. It's unnatural. The many other aspects of 2023 and 2020s, in my mind it's 2020s. It's going to be stagflationary for a while. And you'll have cycles. We had cycles of market moving up in 1970s, by the way. Savings rate. It's really low in Europe and US. Extremely low. And one of the biggest component that drives markets is saving rate. That's why when we'll show you, or I'll show you as to what asset classes we are bullish or countries we are bullish, we're bullish on China. Saving rate is 40%, they're sitting on money. Massive cash. As an example, Asia in general has a high saving rate. India is 25%. Singapore is high. So countries which have high saving rates will tend to benefit. But there's a story I'm going to talk about subsequently as to what we feel is going to happen. So saving rate has dropped in US to a ridiculous level. And I like your point of being negative. Credit card usage is very high, at all-time high.
If you take into account the US government's deficit financing.
And if you take care of the fraud in the pension industry, which is not yet out, okay, I'm really sorry. A lot of times my friends like Mahir, Anand is there. Right? They tell me go to institutions to raise money. Let me give you one data. Most pension funds will be bankrupt by 2020 or 2030. They don't have money for liabilities. Okay? I'm not going to show the maths. They don't have money.
That's usually the case with pension funds.
Sir, the issue is while we see lot of things we talk about regulation, it's an important point. Moratorium is so important. In United Kingdom, majority of pension funds are levered. I think it's the biggest crime they could have made. Nobody's been put behind bars for that. How can you put pension money and take leverage? It's levered portfolio. That's why Truss lost her job. I have a question to ask. When Obama said that he's going to print money, market cheered. When Truss said she's going to print money, that's hypocrisy. Right? It should have gone up. Have you heard of any other country, if Singapore decides to print as much as the GDP, $350 billion, what happens to Sing dollar? US did that. It went up. That's called neck economy. That's a reality. So, long story short, not only the savings rate is an issue, but we expect earnings to contract. This is, to me, the biggest risk of 2023. And the leading indicator of that's going to be the unemployment rate. Right? If the unemployment rate doesn't go up rather fast enough, then don't expect a bull market. Because if unemployment rate goes up, what happens? Fed pivots, starts cutting interest rates, stock markets go up. All of you are chartered accountants. The cost of capital is in numerator or denominator? Sorry. Denominator, right? If it goes down, what happens to PE multiple? The justifies price to earning goes up. There's no brainer. Right? So, Fed will pivot if unemployment goes up fast. That is why they are frustrated. It's not going up fast enough. Well, possible scenarios. We expect interest rates to continue to move up, around 100 basis more in EU and 50 to 75 basis more in US. People are talking about 50, 25. Of course, it's not going to be 50. They've already done 400 basis last year. That's 8 times what it used to be. It's bizarre. Anybody who's done finance, basic finance in class, our early days, even undergrads, know that the effect of interest rate change happen with a lag. So it's going to reflect in 2 quarters from now. And they will continue to maybe increase by 1 or 2, 25 basis more, maybe twice or thrice, till March or April. Somebody asked me, should I buy bonds? Of course, yes. But the day Fed says they pivot, that's the day it will go up 10%. Don't have FOMO, fear of missing out. It will still go up. Right? So just wait for that magical statement. However, the challenge is, Fed is sincerely hoping that there is no hard landing. Not because it's bad for economies or in general population, public opinion, but because they will have no choice to reduce interest rates fast, and everything because of which inflation went up is back, because commodities will go up, asset classes will go up, and the same issue which was there earlier will be back. And that's why we say inflation persistency is a risk. Okay. Can you imagine which other year something like this would have happened, where equity and bonds would have fallen like this? And if you look at this chart, anybody can tell you that the 40-year bull market in bond market ended. Anybody who's below 55 years hasn't seen a bear market in bond market. I am 45. Anybody who's below 55 in this room hasn't seen a bear market. Because I'm giving respect, somebody who was 55 or who's 55 or above essentially was 15 when bull market started. Maybe in their teenage they would have seen the ugly side of bonds and the better side of bonds. It's a reality. It's a 40-year bull market in bond market. Majority of investments here, when funds manage, they're levered. It's a harsh reality. So this is an important point which has happened. And as I said, 30-year bond, worst return for a single year ever. US. Somebody asked me, corporate bonds, are they safe? Well, I answered, maybe they are. But if AAA rated UK bond can potentially be bankrupt and it was just very close to it, what makes you think any other corporate bond is safe? Just a thought. The basic point here is 95% of the time professionals and entrepreneurs spend on wealth creation, including me. It's the biggest paradox. Only 5% time is spent on wealth preservation. It's a very, very important point. 2020s is about preservation. Preservation doesn't mean you don't grow your wealth, but preservation for sure means to make sure you don't use instruments or tools that can destroy your wealth. And I've never used leverage, 22 years in financial services, zero debt across portfolio, including companies we invest. First thing we go is, I hate debt, I go and remove debt. All our companies are zero debt. So in 2020 when the world crashed because of COVID, I saw the biggest hypocrisy of 2020s. Private sector is supposed to be profit driven and they started asking for government moratoriums. We didn't need any because there was no debt. Okay, this is a chart. Average is 15. The last 140 years S&P 500 averages 15, 1-5. Of course, in bull markets it goes up and in bear markets, sentiments. Price moves because of behavioral finance, nothing else. It's a human psyche which drives price. So if 195 to 200 is the earning, if it happens, I'm not saying it's going to 3000, S&P 500, but nobody is talking about potential risk of earnings contraction driven erosion of equity prices in H1 of 2023. It's a big risk. May or may not happen. Knowing your risk is important. I think my job today is not to say that this is going to happen or that's going to happen, but to appraise you of the risk. And that's what I'm trying to do. The biggest risk to me is earning contraction of S&P 500 and obviously other equivalent indices abroad. Okay, 1650 was the gold price when we gave a buy call. We are not technically driven. We are fund house. I think that journey is still not over. It can go up further, 2000 plus perhaps over 18 months. Now let's cut through the noise. Let's talk about 2023. But you can't talk about differential calculus without learning arithmetic and algebra, right? Basic maths. So I had to speak about 2022 and the context before I talk about 2023. Let's move forward. Status of US stocks is likely to get shattered. Okay. My partner, there's a colleague Chandan who helps me in this. He's based out of Dubai, he heads the UAE desk. He and I debated. I gave him a headline, end of an era. He said that's too dramatic for a formal forum. Let's moderate it. I'm talking United States stocks. US, I'll just give you a few data points and please appreciate the data. While the GDP of United States of America is 24% of world GDP, its equity market as is represents 46% of the world market capitalization. Anybody can tell me the favorite tool of Warren Buffett? Anyone? Thank you. It's very close, market cap to GDP. It's market cap to GDP. You should be shorting US. You should be shorting US. $100 invested in United States stocks in March 2008 is still worth $288. Whereas $100 invested in rest of the world, that's why I said net economy, is worth $94. What a paradox. The outperformance of US stocks was fueled by a declining interest rate regime. I call it secular run because of stagnation. Not stagflation, stagnation. Stagnation of interest rates. There was zero. Interest rates stagnated. Literally. I mean, small movement here and there doesn't matter. The negative yielding era has ended. That's the point. $18 trillion became zero. Negative yielding, there was negative yield in many parts of the world. I actually internally remember in the team across countries where we have team, we did a call that today is a red herring day. Why? Because from minus, it just moved to plus. I mean, if you love financial services, those are the days when you see Germany from minus 0.1 becoming plus 0.1. That's a big change, right? Imagine, you had to pay money to deposit. Now you start getting money to deposit. It's a big deal. Because capital budgeting process, which all of you do, how do you do it? I was in Indonesia CFO Forum, first physical event I was a speaker, 100 plus Indonesian CFOs, 5-10% Indian origin as well. And a lot of them during Q&A started asking about the dollar debt issue because of dollar index. I said, tell me something, why are we so enamored with US dollar? Why did you not go and buy or take euro debt, yen debt, pound debt? Because Indonesian rupee appreciated pace each. Across world, most emerging market currencies appreciated against yen, against pound, and against euro. Why are we stuck in capital budgeting on US dollar? It's a psychological barrier. Think about it, and nobody had an answer. These are large multi-billion balance sheets people are managing, including VC bank. Think about it. We are just stuck. The gold standard is dollar. Now the beauty is, this change, and the reason I genuinely mentioned is that the cost of capital is in denominator, because that led to a 5 trillion fall in FANG stocks. I haven't even factored the other stocks like Zoom and all. Right? $5 trillion erosion. I was talking to a few friends in technology. We've done 19 tech investments over 2 decades. In US, I was talking. One of the seniors in Infosys also is a good friend who's on our technical council. So I started asking, earnings are good. Facebook is at 11 PE. 11 PE. Why would you not buy it? It went to 90, it was at 9 PE. And people are retrenching. Facebook is retrenching. You know what he told me in reality? That there is panic in the senior management because the value of their net worth has got eroded by 70% overnight. Think about it. Just get into their shoes and think about it. If, like in a matter of 10 months, imagine those who actually owned, it's very sad, those who owned those stocks, ESOPs, and suddenly 70% erosion in market cap. What happens? How do you think they will react? They think the world has ended. It's not. Earnings are still good. It's just the perception of justified PE which changed. You can calculate justified PE. What should be? Basis cost of capital. Right? And that changed. So, this is the chart to just corroborate the point. A negative yielding debt crash from 18 to 0. Slumdog billionaire. Sorry, technology. Right? It is still 21% of S&P 500's market cap, even now. To give you comparative, Japan, technology is 7% of market cap. Emerging markets, 13, Europe is 13 odd. It's still 21. It was far higher. At its peak, it was 40%. People were still buying. Rest of the world, now this is very interesting. Please go back to a milder statement, end of era. Because if you look at the deviation of rest of the world in terms of returns versus US, it is bizarre. It's almost 3 sigma deviation. We call 3 sigma deviation as a crazy event, right? So logically, what should you do? I don't know. I'm going to short US and long rest of the world. Buy the world. The 2023 first statement of today, buy the world. Minus US. Right? Because if countries like, I'm just not saying India alone or Singapore alone, buy the world. My biggest bet is China and Europe. You heard it right, Europe. How many people would be bullish on Europe? None. Am I being brave? Perhaps. Investors should be worried. Are they there? Some of them? Yeah. No, they are. I can't disclose. But I'll show you data. In the past 2 months, Europe has equity market outperformed US by 1500 basis points. Anybody knew that? Eureka? 1500 basis points, 15%. Outperformance was driven by lower price of oil. Europe is a net importer of oil, like China, like India, like Japan. Natural gas prices crashing, China reopening, so supply shock reducing, and the peaking of PPI. PPI is more important in Europe than CPI. CPI is consumer price, PPI is producer price. That's a manufacturing hub, so PPI is far more relevant than CPI. Because Europe is aging, average median age of Europe is 40 plus, 45 odd. Median, not average, median. Median is far worse, right? So it's not a consumption basket, it's a manufacturing basket. So PPI matters more in Europe than CPI. Basic fact. US tech as a percentage of US equity market was 40 versus 19, 13, 7. Derating. And 7.5 trillion buyback. Now this is the most important point. United States stocks, companies have driven 7.5 trillion buyback since 2008. 7.5. Now if the cost of capital is up, buyback tax is 1%, we believe it's going to go up. What happens to buybacks? Personally, professionally, I believe, in the sense as a fund house, I believe, it's going to get diluted dramatically. Okay, now this is just a very important point. What event, if at all, can trigger? By the way, everyone is negative. I'm not. But everyone is negative. However, what can trigger? Rather than thinking whether people's sentiment is bearish or bullish, let's understand if it has to go down. What can trigger it? Right? Because if you start seeing that happen, if I start seeing that happen, I will tweak my portfolio. Somebody asked me, dollar, will it be the gold standard in next 15-20 years? I don't feel so. Some of my investors, what will you do if that happens? I said, okay, tell me which currency will be, I will shift to that. My fund is dollarized. You say yen, I shift to yen. If it's euro, I shift to euro. Having said that, in the last 200 years, there is one country which was neutral in World War I, II, and any conflict. And they lost their neutrality and joined NATO. Any guesses which one? Sweden. Sweden. So if the countries like Sweden, who were neutral for 200 years, they lose their neutrality and join US, what makes you think US is becoming weaker? Having said that, I will give you a data point why I believe that 21st century is century of Asia. Not because I'm standing here, I said the same statement in London. Because for a very simple fact, Asia has 50-60% of world population, but 20% of world GDP. Fast forward 25 years, it's 50-55% of world GDP and 50-55% of world population with 75% of world saving rate. Do you need any other data? Now, potential credit event. Now, to me, these are the triggers. If you start seeing unemployment going up, our projection, it will go up by 50%. Unemployment will go up by 50% in 2023, which means from 3.7, it's expected to go to 5.5 odd, in our opinion. If that happens, then there is a challenge, because stock market should go down because of earnings, not because of inflation. Of course, there will be deflation. Deflation, not inflation. There's a risk of deflation in 2023. Yes, you heard it right. We believe there's a risk of deflation. That's why these 2020s are going to be, first statement of today, turbulent. When you fly, turbulent doesn't mean you are going up or down. Just very bad feeling. It just wobbles, right? Especially if you're flying over Bay of Bengal and you're in the restroom. Okay, potential credit events. Do you know that the credit card delinquency, in spite of the portfolio size, is at all-time low in the last 50 years, 2.1% compared to average of 3.8, expected to move up. Low corporate defaults, 1.5 compared to 3.5 pre-2008 crisis. All expected to move up. We believe a shadow banking event, already FTX and the likes are happening, but something there can be a big risk. And to me, the biggest issue is the low saving rate. It's really bad. The saving rates are really low. Because if you put money in banks in Western context, you're losing money actually. The value of money is going down, right? And hence savings are eroding. And in any case, the history says there have always been a consumption basket. I think what we should say is they've always been a credit card market, right? And that's a very, very serious risk. So these three things, if you ask me, are, because if this happens, it will trigger these, right? So just, this is something, is the most important parameter to look at every month. Just some data points. Very interestingly, German import prices dropped the most on record in November 22, most on record ever. By Europe. It's a manufacturing hub. Euro has appreciated, right? Look at the data. Data speaks for itself. A striking contrast between US and European equities. Cumulative inflows. Right? But the most important point to me is the smallest outflow from European equities in the last 47 weeks. In spite of all what you have heard about Europe. Interesting, intriguing. So what are the top investment ideas for 2023? It's completely an opinion because it may or may not happen. I repeat, it may or may not happen. Short US dollar, long EM in European assets, long EM distressed bond, H2 we believe corporate bonds, not H1. H2 we believe corporate bonds will rally. You already see things like Korea, the currency improving because of China reopening, and Mexican peso improving because of nearshoring, Europe recovering. Long China, China has very high excess savings, and to us Chinese stocks remain very contrary in long term because the main event has happened. Two events. 1-0 Politburo and zero COVID policy getting diluted. Both have happened. Long gold and copper. China opening means copper inventories are going to be fairly low. They are already low, and we believe this could be a very strong play, copper and base metals for this year. Why long gold? Because of Cold War, lot of central banks will start buying, and they are buying, including Chinese banks, they are buying gold rather than US Treasury. Right? So it's a very strong macro. Long global industrials because of localization, and if 2020 was a deflation story, and deflation, obviously growth stocks do well in deflationary environment, tech, 2023 and 2022 onwards is an inflationary story, which means industrials tend to do well, and localization is the key. Short US tech, Tesla is still what, 90p? I don't know. It is still 90p. I don't know. 110. It swings a lot, so I don't know. Right? 30 US Treasury, long, we believe, and long EU banks, and short Canadian Australian banks. We believe real estate is in a bubble in Australia and Canada, in these two markets at least, New Zealand included. I'm just taking a pause here. Yeah. Basically buy the world. Okay, what can be a good approach for investors in such complex scenarios? We believe income fund, yields in general, anything which generates income which gives you dividend. We did something similar 18-24 months back. We say we tried NAV went up every month. I can't talk much about it, but every month NAV went up in the last 18 months. That's data. I can't make bricks without clay. Mr. Holmes said that. 21st century Renaissance, any idea? Renaissance of 21st century? 17th century Renaissance, Industrial Revolution. Yeah? 21st century, and you know what, Europe, they had a great conquering across the world because of, there was nothing called intellectual property, so they stole gunpowder, right? But there was no IP, so why do you say steal? A lot of people say steal. I said, excuse me, there's no IP. One of the 10 commandments of TRW Capital Group, if a competitor is doing better on something and it's not proprietary, copy it. Where is it wrong? Experience curve effect, I repeat, experience curve effect says the second player makes more money than the first player. It's not eBay. Right? If it's not proprietary, copy it. It requires a lot of humility to copy it. Right? Because accepting somebody is doing better, right? It's not easy. So, the 21st century Renaissance is technology. It's a big competitive advantage. And we have done few acquisitions in the last few years, primarily data scientists who don't even understand F of financial services. They just do predictive data analytics. That's it. And we've done another acquisition we haven't disclosed on quant side, both debt, both equity, right? But we haven't disclosed names yet. But it's at a balance sheet level of TRW. Just 2-3 minutes about us. Is that okay? Sure. 3 parts of our business: investment side. Okay, I don't market in Singapore, and I mean it. All our clients majorly we have here, but are abroad. Like US alone, we have investors in 13 states of the United States of America. Offices in Bahrain, UAE, India. India we have in Trivandrum, back office. We have Mumbai, Delhi, Singapore, starting. Next is Brunei, okay. We are about to start a Brunei desk. Second part of our, so we have buyout funds, absolute return, some more, which we haven't disclosed yet, but we're launching a Sharia fund. We have a very renowned scholar, Dr. Aslan, who's joined us. He is basically deputy chairman of the Malaysian Central Bank, on board of Maybank, APSA, United Arab Emirates Authority, Bahrain Authority, and the likes. So he's joined our council. We have a credit fund. We acquired a clean, which is the best performing fund for the last 4 years. And we have acquired a hedge fund, which has delivered 18% dollar net over the last 9 years compounded. So that's on the fund side. Consulting, this is core to us. That's my expertise. That's TRW's expertise. If you have to ask us what do, we are consultants. We have historically bought junk bond companies which are like not performing and turn them around. That's been our forte. The first one we did when we were clearing Emphasis, BFL Software. I don't know if you've heard. Jerry Law merged the 2, incubated Ensos Club, the 3 sold to EDS, Blackstone company now. Then consulting, we primarily do operative intervention, primarily doing 5 things. Sales effectiveness, if you have poor sales, we solve it. Digitization, if you have offline business and you want online revenue, we solve it. Channelization, IPAR, integrated cost rationalization, and lastly, basically, revenue assurance. So these are the only 5 projects. We have clients across. The only thing is, we don't charge much, we only take profit share. Whatever incremental profit we make, we help, 10% of that incremental we'll take for 15 years, but we'll not charge anything. And 90% for them, 10 for us. That's what we do. We have clients across multiple countries on that. On the family office side, we have basically all our clients, as of now, majorly 90% are in Europe, France, Germany, Austria, Switzerland, and our forte there is family governance. I know Singapore, we are very strong on the structuring side. Patriarchs and business owners, they are scared of only one thing. When they're no more, they'll be family feuds. right? So we have we go and solve that, create governance so that they don't fight. So countries which have aging populations, that's where our clients are majorly. Okay, little about the team. 50 people strong overall, few members mentioned here. Singapore desk, Shiroy is here. Shiroy, just right. Today, okay, he's just gone for a call. Vansi, they're both partners. Elizabeth, she's ex-Bankem. Vinod drives our family office. He is ex-head of LMM for MENA region. LMM is a sister concern of First Advisory, which is the largest trust company in the world. Ashwin, 18 years Stancy. South India desk being run by primarily India, buyouts Punish Flow, Chandan drives UAE and multiple other things. Zero attrition in last 10 years at principal or above across 50 people. Okay, Mr. Wiles in London, a renowned banker, is working on in Nordic countries or turnaround. Mr. Gandhi's done 320 IPOs in India in last 40 years. He's on board of Sundaram Clayton, holding company of TVS. He was on board of Dr. Reddy's for 15 years, 87 to 2002. Oscar and the likes. Mr. Satyamurthy, retired Deputy Controller Auditor General, till recently was working with you, also the honorary of the Anti-Corruption Academy. Mr. Moiz Ali Bhai, Africa. I've tried to get different continents basically. He's the Aga Khan Healthcare Chairman and Aga Khan University Chairman basically. Well, that's a little on us, but I don't know was it too heavy or not. But if you have to ask me two takeaways, buy the world and observe the unemployment rate in the United States. Those are the two very simple takeaways because I in board meetings like to have very simple takeaways. So those are the two simple takeaways.
Thank you. That was a bravo presentation. Too good. Thank you so much. Now we'd like to open the floor for question and answers. May I please request Fatima to help me with
Thank you, first and foremost, thanks for the very enlightening presentation. Okay, I have one question. You mentioned that you're expecting a deflationary trend in 2023, and you also mentioned probably Fed will pivot by the end of 23. Now, in such case, my doubt is it will lead to eventually a reduction in cost of capital. Now, in a way, won't it help those tech stocks which are actually profit generating? I'm not talking about those which had rallied basis just perception, but the strong ones, particularly in cloud sector, those so will they benefit? That's because we've seen a huge drawdown on those. So our question is that probably it might. Do you think that that'll happen?
Okay, so answer is absolutely yes. So basically, if you go with the traditional story of how we learn finance, which is the concept of the basic elements of cost of capital, how you calculate justified PE. It's a very simple thing which is called PEG. What you are saying with good cash flows, because stock has fallen a lot, the PEG is less than 1, the price to earning to growth ratio. If the PEG is less than 1, it's, in my opinion, irrespective of sector. So because you have already put a condition rightly so that tech company which is profitable. So I'm saying any company which is profitable with PEG less than 1 is a value buy unless you see a governance issue. So you're absolutely right. Having said that, then it's about active management. So people who can actually go through and identify those stocks, absolutely yes. I believe Fed will pivot faster than 23 end. In our opinion, they'll pivot in the next 3-4 months.
One more question. So what do you think are the tailwind risks? For example, risk to your hypothesis saying, because you also mentioned that supply chain is one of the significant contributor to inflation. Apart from, of course, there were 3 pillars, wage, liquidity and supply chain. Now, liquidity in a way is getting drawn down, okay, by $90 billion every month. Supply chain is easing. Wage inflation is definitely an issue even now. So, do you think that probably, that is the reason in such case, will it eventually benefit? Of course, the reversal to mean of PE for US market can happen. But if we see cost of capital coming off, then the equity risk premium at this point of time is looking very expensive. Probably that could be better. Do you see that scenario?
See, eventually one thing is, let's understand that over time everything goes up. Age, stock markets, assets, real estate, gold, everything. It's a fact.
Relative
So
performance.
everything goes up. In reality, if you calculate over last, who was the most richest person ever on the planet? Genghis Khan, Mongolia. I did some research. So the point is, everything you're right, it will go up. It's a question of what and when, right? Now, the most important point in what you're saying is to be factored is essentially earnings, right? What is return? Return is the multiplicative effect of growth times margin times PE, and there's a fourth, Forex. I haven't learned anything better than this in 25 years. Growth times margin times PE times Forex. If growth gets diluted, margins get compromised, right? By design, the perception of PE will come down. It's still very high. And very important point, the translation loss for US companies is bizarre. Most tech stocks have 50% plus earnings outside US. Last quarter, 8% increase in dollar compared to rest of the basket, which is not factored in earnings. Like translation loss is something nobody's talking about. So if you factor all of that, those risks on the earnings side are very high. If they manifest, then why Facebook went up? Because they started sacking people. So perception of margin improving, right? When actually companies, they are doing it because perception of margin improving, so stock goes up. So I'm saying answer is yes, but I will be in my portfolio, because I can only talk about my portfolio or my client's portfolio, be extremely careful in H1 and extremely bullish in H2. It might so happen, may or may not, that it goes like this, 1 or 2 days return is irrelevant, and then it goes back, and we are there where we were today, which is 4,000 index, that's S&P. But the earning risk is very high. And you also asked in the beginning, what's the biggest event risk? Taiwan. That's the biggest event risk.
Anybody else? Who's the next one?
I mean, nobody can factor it, right? Let's ignore it. Because Asia gets impacted the most with that. So,
Wonderful. Really enjoyed thoroughly.
thank you.
Very insightful. Just only on the Europe, I'm not able to gel your view on bullishness on Europe. The 2-3 reasons why I felt it should not. One, the social security rate in which 30% of people are working, 70% are retiring on their income. Highest tax. Aging population. Migrations are getting restricted. Cost is high. So, and then disintegrated Europe and everything else. So, in what form and manner you believe Europe can come back? That's one. The second question related to that, or independent of the early gentleman's question, the stock markets always price in 1 year forward payment. That means people are playing about 24 earning, not 23. 23, the first half will be lower, factor already. So what more shock can come because of that population?
Sure. So, okay, see, very fair. Let me give you first of all, agree with your data point. From a medium-term standpoint, there is only one parameter, because you brought it out, I would like to mention that, which matters on this planet, average age of the country. If you map the average age post-World War II, whenever is in late or early 20s to early 30s, in that range, the country does extremely well for 10-15 years. Baby boomers in 1950s, 60s in US, then moved to Margaret Thatcher days. She was lucky, average age of UK was far lower at that time, with due respect. And then Japan, then Korea, China, it's Asia, and 20-30 years later, like average age in Africa is 18-19 years, right? So that is the trend, and hence it moves. Unfortunately, however, if those who are allocating money, right, the institutions, for them it is question of the incremental pension which is coming, where do I put money, right? So I'm talking short term. 2023 point of view, think about it. FTSE is at all-time high. How many of you can believe it? Doesn't make sense, right? It is. Germany has gone up 14-15% return in the last 2-3 months, right? Because that same perception, your second question is the answer to the first question, sir. Forward, you only said that people will factor 24. So now the perception of crisis, imagine in spite of Ukraine issue, energy issue, inflation at 45, all those issues which could have happened, still most estimates are talking about negligible to no negative growth in Europe. Right? If that's the case, and now inflation's tapered, currency is back, the current accounts have improved. Germany's last quarter was the best export minus import number. Then it will manifest in incremental smart institutional money going into that continent from 2023 perspective.
Just one more data point. We always, in talking terms, we say we all sit on huge cash. Everybody, all the investors on the sideline. You have any data point to see that investable money, but sitting on the fences, waiting for investment? Do you have any data point there?
Okay, I'll give you a bad data point because I'm quite worried about it. Off balance sheet, all of you understand.
Yeah.
$63 trillion of swaps on the planet. 2020s, I'm very scared. Since you asked, I don't want to scare people in 2023. $63 trillion of swaps, which is off balance sheet on the planet with a GDP of 97 trillion. So, I'll tell you, I've been invited to risk committees of certain banks in the sense of this part generally, just as an opinion. Somebody asked me 1 year back, which is the biggest risk for the bank? I said, see, there are primarily 3 risks, and you know better. Okay, I'm not a, right? But one is retail defaulting, unlikely, except for credit card in US. Corporate defaulting, loans, the balance sheets are far better this time. Country defaulting, your counterparty risk. What about interbank lines, sir? That's at risk. Keep counting the number of countries which are defaulting. So the interbank lines are at risk, in my opinion. And trust me, 6 months back when we met on this point, I used to talk about counterparty risk is low. My statement must have got discounted. FTX happened, right? Counterparties are so important. I think the biggest element here is counterparty risk. So,
yeah, thank you very much for the nice presentation. You had mentioned that your advice would be to short Australian bank. With the Australian dollar so low, and China is going to pick up suddenly from this. So Australia will be one of the major beneficiary by way of commodity price increase. So with all that factor in mind, you still believe it is good to sell Australian banks?
okay, see, it's relative. When I say short, I basically saying don't buy, right? That doesn't necessarily mean you'll make money on shorting because let's say, for the sake of argument, European banks go up 15%. Maybe Australian banks go up 1%. But if you short that and long that, you'll make 14 effectively, right? But to your point, this is the biggest risk in Australia is interest rates are moving up. Just ignore dollar for a minute, Australian dollar, because if I'm sitting in Australia, my earning is in dollar, Australian dollar, I really don't care about the swing, and I'm buying Australian property with leverage. And when cost of capital goes up, and I've had serious trouble in raising money from Australia. I have a dozen odd clients. That too, why they have invested? Because that's through self-managed superannuation fund. Self-managed superannuation funds have zero tax on global dividend income. So that's the only reason I'm able to take money from them. So my only clients are those who have a self-managed superannuation fund. Otherwise, it doesn't make sense for them to invest because they just take money from bank, buy a real estate, make the spread, and it's a killing double-digit dollar return. What about reverse carry trade now? Because that's an illiquid asset. And if reverse carry trade starts, when most retail clients are levered, HNIs are levered, and there is a pivot point, right? The asset liability mismatch on a 20-year tenor, 30-year tenor loan can be bizarre. That's the risk I'm saying. And that can lead to higher credit defaults for banks. That's the only reason I'm saying this.
So what's your view on the Australian dollar?
Okay, in general, commodity-linked currencies will do well. I'm bullish on base metals, so Australian dollar should do well. But I'm just saying, if I'm sitting inside Australia and I'm buying Australian property with the money I'm making in Australia, it doesn't make any difference. Like I have a property in India, I've lost 5% compounded on 20 years, but the price has gone up. I'm dollar terms, right? To be precise, I shouldn't be harsh, it's 3.75% roughly I calculated. That's the depreciation of the currency generally. So that swing is bizarre. So if I am inside Australia, it doesn't matter. I mean, the Australian dollar appreciating is not going to make a difference. On the contrary, think about it, it's an exporting sector, so it's a paradox. So while base metals should do well, if Australian dollar appreciates, there's an unlinked translation loss as well. So there's a reverse carry trade there as well, right? I mean, I'll short crude exporter countries generally. Now, this is not crude, but crude exporting countries and long crude importing countries in general. So now, if you take China, India, those countries which are Europe is a net importer of crude, right? That's another angle, sir, in Europe. It's a net importer of crude.
So in that context, can I go long on Russia?
How?
On commodities.
It's a very difficult one. You know why? Because I was in Bahrain without naming a client, obviously. He said, what are you doing? Do you have connects in Singapore government? I said, well, what happened? He said, I have Russian oil, which is labeled in some countries without naming, which Europe is buying. If you have connects, we can do it there. I said, okay. That's the entire oil which Russia is buying is getting packed in some countries offline without naming it. So what do I say? So it's very difficult to say. Having said that, if you can get stake in rare metal, rare mineral, those companies, especially in the Siberian context, that can be a game changer. And actually, somebody told me in UK, said that if you have connects in Indian government, why don't you introduce me? I want to give them a tip. Say instead of $20 discount in oil, take only 10. But that remaining $10, give me stake in rare metal companies, rare mineral companies. And entire Europe and US will be very happy about it. Then we mark it. Interesting.
Yes. Interestingly, in all your conversations, we somehow did India was missing.
I'm bullish on emerging markets, I said. I didn't specifically point.
So what do you mean? You mentioned about China.
No, so I said India, China, Europe
Okay.
are net importers of oil.
The last 2 years.
No, even earlier I said that all of them should do well.
Okay.
And I also said that in general, any country which has average age, which is lower, will tend to do well. And I said Asia, this century is the century of Asia. And I'm very bullish on India. But I have only one point to make. Typical returns closer to election years tend to be bad. And currencies depreciate because money has to flow in.
Hi. Thank you for the awesome presentation and the key takeaways. It's like really helpful to remember the entire presentation. 2 questions quickly. I was about to ask about India, and particularly my focus is some of the IPOs we have seen that were launched with a lot of hype. They really did not do well. Any specific reason you think that happened? And the other question that I have is, I work for a tech company, and you mentioned today about the tech companies. The dilemma we are facing is the shareholders are giving us a lot of pressure to cut costs, cut employment, while the company's vision and mission is to invest heavily in technology and to kind of forge ahead. So, what would be your suggestion, and what do you see generally the industry or other geographies are really doing?
Okay, see, purely from an end employer, I'm an electronics engineer. I've done Verilog hardware design logic on MacLayer for GPRS Siemens Gateway project in late 90s, just to do comparison. And I got, like, my seniors got a pink slip in 2000. That scared me, and I did an MBA basically. That's the genesis of I standing here, right? It's going to be fantastic opportunities 18 months down the line for employees and in general skilled professionals in technology because of the mistake shareholders are making, and they are making companies remove talent. I started by saying that there is no crisis, but because of the price, there is a panic which has set in because when net worth erodes, a manager's money, suddenly net worth gone down, how will he or she react? Sack people. So there's going to be actually a very serious challenge because in most projects, digitalization, you know better than me, so many things happening, the demand for talent will actually go up. There's already shortage of labor. So this is just temporary in my mind. But I still believe, while tactically some stock, like you said, and I can show a recorded video in Delhi in November. I said, they asked me any tech stock. I said, because I'm not in US, I can say I bought Meta at $91. It's recorded, you can check. But that's my personal portfolio. Because 11p at that time, 9p, no brainer, stacking people makes sense, right? But in general, because cost of capital, unless there is deflation, I'm not a big buyer of tech. There could be technical bounces, but there is no strong macro right now. Because you have to understand 3-4 things. Penetration level technology-wise are far higher, right? Regulatory risk, tell me. How many issues are coming because of regulatory and the taxes and regulatory tax, I mean, that these companies have to pay now, whether it's in Australia or US or some other, Europe and all. That to me is a big risk. But value shift, companies which are going to disrupt the value chain successfully and there is adoption, those companies will do very well. And I'm not a VC. But I can tell you, value shift has always made money. There are only two things, and that's why we are a buyout fund, because I'm not a VC. Why? Because in 21st century, after 2008, in general, nominal growth globally has come down. Earnings grow at nominal, not real growth. That's important to understand, right? They don't grow at real, right? They grow at nominal growth. So when, in general, nominal growth globally comes down, then by design, there are only two ways to make money. One is margin expansion. So you buy a junk bond, turn it around, it makes money, right? I was a moderator in ABC Singapore last year, inaugural session. My co-speaker was, I think, main head of Asia. And he was explaining that they bought a Japanese company where literally the owners put a pencil on behind the ear. And we have bought it because we are digitizing it, hence margin expansion. Logical, right? Japan. So my point is, wherever there is margin expansion will make money from here till next 30 years, unless you are making money in Africa. And alternatively, value shift, which is technology. But my biggest issue is adoption risk. I don't know what will get adopted commercially. So I cannot define that. Having said that, there are enough companies which will make money in technology. Basis what somebody mentioned there, which is free cash, very less PE, and obviously earnings giving a better. I mean, Netflix gave a 50% return in last 7-8 months. I don't know if some of you have seen that. Right? More than that, I think. So it depends. It depends on adoption.
Last two questions for today. We already have that lady in black. You can ask your question, ma'am.
Yeah.
She defines it. Sorry.
Hi. Firstly, thanks for the insights that you have provided. I think, and also what we can expect from the trends going forward. One of the questions which I have is, given that now the net importers of oil, be it China, be it India, they're trying to replace petrodollar with rupee or renminbi. What does it mean for the US markets on one end, as well as for the commodities on the other, because it's all traded or kind of priced in dollar terms. So if we are seeing that countries are planning to move away or shift their reliance on dollar, what would it mean for markets in general?
Okay, fair. See, so two parts to your question. First, I'll say which is more philosophical, which is US dollar versus other currencies in general, or which currency will become, I guess, the gold standard. I have a very simple point. Financial assets and real assets are very different. The financial assets to GDP ratio is around 6 times, which is bizarre, which is reduced to 5.2, which is still bizarre. And in general, if you look at institutions, they're very bureaucrat. Private, public, at large. And hence decision making doesn't change overnight. So I remember one of the institutions in Europe invested with us, wherein we gave 13-14% net dollar compounded over 20 years. 2008 crisis, they said they won't invest. Why? We are over allocated to private equity, then over allocated to Asia, then over allocated to India. Right? So even if they dabble, now there are countries in Africa, I'm forgetting the name of the country, which actually started doing major work in Bitcoin. And that's a disaster. So unfortunately, what has happened in the last 1.5-2 years, even in March, somebody asked me, will crypto be the way forward? And I remember saying, because you're saying crypto, rightly so, and Russia can use it, you will see the global democracies from the Western context will destroy it. Because they will not allow it to be the payment solution, right? Now here's my question to you, just or as a point of to ponder. Crude at 120, that made a lot of sense. And that's a question which was really important when it was 120. Crude at 70 and crude at 50. And incrementally, climate change, green energy, ESG, all the story, hydrogen, someday it will happen, right? What's the relevance of petrol? So if you ask me, next 5-10 years, Sweden issue, other issues, even financial institutions, they'll continue to hold dollar. However, if you talk about 20-30 years, it's a multipolar world. It's an Asia century, and it will happen. It's a flutter of the cat when they are shut inside a room and whipped. That's what's happening to Western context right now. I invest only in dollar, but I still want to say that, right? Because my investors like dollar. I go and offer them anything else, they don't like it, right? But in reality, the fact that majority of savings is this part of the world, right? And Asia also includes Middle East. I mean, Middle East is very rich because their cost of capital in terms of crude is very, very low, right? Especially Saudi and some other countries. So Asia will do extremely well. And 20 years forward, petrol is irrelevant. I hope so. Otherwise, it will be 500, 600. So that's, I believe. So I don't think so dollars changing from a financial institution standpoint so fast. It takes a lot of harsh decision making, and who will bell the cat? Who will be the first? Very tough.
My question was very basic. You said zero debt, you love to be invest in the companies which is zero debt, or you make it zero over there.
We make it zero. We buy companies which have debt and make it zero.
So, but the first chapter we learned in life, finance was the capital cost to be reduced by having the debt.
Okay, brilliant. So what's my role and your role? Think about it. My role is to sell. One of the basic tips I want to give in India, Singapore is the hub mecca of what I would say financial services and fund managers. I'm nobody. I just manage very little. It's not important what valuation the company has when I'm buying. It's important what the valuation is, what I'm selling. This is what I have done. First chapter, right? And companies are a going concern. That's the most important thing, which has got diluted with Series A, B, C, D, E. I don't understand that at all. A lot of people when they come and say, I want Series A, I said, what do you mean? I thought companies, that same chapter taught us companies have to be going concern, right? And people come here and ask for money for 12 months. What happens after 12? Series B. What do you mean Series B? It was never there in my books, right? It's nice to talk, right? It's very nice to talk. I hate that jargon. So I'm with you on that. However, coming to your point, when I have to sell, you know the joke? Bearings, we bought Emphasis. It was loss making, turned it around, sold it. 2008, one of our global institutions was selling. We bought again $50 million and sold at $350 million. So what happens, the joke is, here's my point. If there is no debt, my sellability goes up. Because you who are on the other side as a buyer will believe that because there is no debt, you can take debt, jack up return, and hence you will buy. But then execution is not a commodity. Strategies are. Some of them will make mistakes again. You know what? Interestingly, in my buyout, there are only 5 types we have been doing for the last 20 years. Only 5 kinds of companies. And same, like next time when I go to I raised my fund in 2020 in 3 months. Because all investors re-up. They're asking me when are you doing next? I said wait for 23 hand. Serious. 100% re-up. So what I do is I tell them, oh, we did a consumer, we'll do another. We did this in financial services, and we did a innerwear company, because innerwear to kharidega. Inflation or non-inflation. Jockey did very well from 2008 to 15. We bought innerwear. We did very well. Same 5 companies, similar, we will buy next time, the next time, the next time. Why should I experiment? I don't get it. My job is to make money. So, long story short, we put 50 million in Muthoot and 15 in Manappuram. And people got shocked in Kerala. 2 companies, competitors, you're putting 100 million, 50-50. Because we believe both will make money. Then I'm putting 100 in one. So sellability is what is important, what I'm saying. And thanks to removing debt, my sellability goes up. And I want to give you another point. In private equity, we pay 8% dividend annually to our investors. 8% dividend. 3i used to do that in 1950s. It got diluted. Nobody does it now. So what happens is I'm a deleverage buyout. So when I remove debt, the same incremental, I don't care if the ROE was 6 or not. Incremental ROE, 6 becoming 8. That incremental 33% cash flow is what I pay back to my clients as dividend. And most countries, including Singapore, have zero dividend tax. The cheat sheet. I hope that's answered. Scalability goes down.
So you have, I think, thanks for that session. Some of these questions also. So there are certain basic assumptions we've seen like let's say the there's a rebaselining that has happened over the last 3 years for the law. We are rebaselining all these things, and then plus we are not taking our BSc last year, but then that's one layer which is real risk. So rebaselining. What does that say that because for drawing any chart, I have to without you, are you saying that unemployment rate still remains around the same and inflation is taking care of it? Therefore, the growth comes back. These are
Okay, so see, from an active fund management, whether you're an individual or a fund manager like me, I don't react to a data. You go and test it out. Any data, whatever is the reaction, that reaction continues for the next few weeks. So most funds and individuals have FOMO. Like today's data, we have zero position right now, literally zero. We sit on 100% cash and rotate. I would love to know how many funds do that. We just move out. I want to trade today. But once that data comes, next 1 or 2 days, Goldman Sachs will write, Bank of America will speak, JP Morgan, Morgan Stanley, 5 others I look at. I don't tweet, but I only follow on Twitter. I'm actually saying the best way to learn about the world is Twitter. And don't waste your time. I'm in Maslow's self-actualization. I don't tweet at all. Not even a single app, just one follower on my Twitter. One. And that's my Twitter. No, I'm serious. I don't tweet at all. I'm not on Facebook. Because if I go to a company, half of the employees will start sending requests. If I don't take it, get offended. Even psyche, best not to be on Facebook. So, but the point here is on your rebasing. Why react? The best way is to just wait for that data. I'll give you a very simple example. You check this year. The day Mr. Powell comes and says that I've stopped now, bonds will rally then and there 10%. Right? The price of bond. I'll miss it out. But it will rally further 10-20% in the next 30-40 days. I'll make that money. But the problem is, if I preclude it, then I will lose also. Right? So, it's Chandan, who's my colleague, last point, very important because somebody asked me how do you, remember, we discussed how do you practice this. I said meditation and all is good for my physical health, but it doesn't help in financial services. Trust me on that. Chandan, my colleague, brilliant guy, hired him in 2009 from Calcutta because he had his summers in Lehman and Lehman crashed. We believe we did it. But, right, so we hired, we were lucky. Those of you who have met, he's brilliant, he's better than me in terms of training. Far better than me. Okay, I'm actually serious. He said something very interesting, and I think if you implement, I have implemented, it works. He said financial market and assets are like a river. Okay? It's like a river. It was flowing before me. Before me means before I was born. It's flowing today and it will flow after me. I just need to take my bucket, take my water and come on the side, and I don't care about how much water is still left in the river. Do you really care about that? How much can you take from the river? Your bucket. The problem is, I keep looking at the river and not at my bucket.
Great. So on that very interesting note, thank you for your lovely and very crisp answers and some witty answers too. So now may I please request our Chairman Sir, Mr. Ramki Subramanian, and our Vice Chairman, Mr. Somnath Adak, to present a token of appreciation.
Venkat, pass the please come. Please, Venkat, please. Thank you so much. Thank you. Committee members, please come here. Haji. Oh, okay. Of course. take a group snap later. So
Surprise.
okay. Thank you.
So now it's time for some fun. It's time for lucky draw. I hope you all have registered. Any last minute registrations? We have a pen and paper here. Anyone wants to register now? Or
Multiple entries?
Okay, one rule you should define if somebody who's taking it out gets his phone or not. Is that okay? Because it happened with us once. Somebody who was taking out took out 0.
You take it out.
No, I'm not. It's a big risk.
so let Mr. Roy do the honors. Let's see. Yeah, go ahead.
Anyone missed out like me for?
Anybody?
Yeah. Oh, just wait, huh? There are a couple of more registrations.
Sorry.
Yeah.
Last minute.
Last minute. Trying their luck. Okay, guys, just first give a big round of applause, no? It's lucky draw time. Okay, so let's ask the question first. Who's ready for the prize? I don't see the energy here, guys. Are you ready for this lucky draw?
Yes.
No, I can't hear you guys.
Very बढ़िया सारे. Very बढ़िया. मेरा तो नहीं निकल जाएगा क्या?
निकल जाएगा से जो सबसे तेज बोलेगा उसका निकलेगा. Are you ready for the draw?
Yes.
Yellow.
Who wants a yellow?
Close your eyes, yeah, better.
Just gonna go in and I'm gonna just put it.
I think he already has. His specs is up.
Same choice.
So who's the lucky person?
Nitin Jain.
Congratulations.
Yes, some advantages to coming late. So he was on top, is it?
Good choice. Thank you guys. Thank you so much. And lovely to have you guys here. So huge. Congratulations, Nitin sir, for your award. Can you please show us what you got? Oh wow, AirPods, are they? Wow. Great. Huge round of applause for him. Okay, so after lucky draw, I would like to invite Prathama to present her word of thanks. Prathama, over to you. Thank you guys. Thank you for being lovely audience.
Thank you, Jagriti. On behalf of ICA Singapore chapter, I'm glad to present the vote of thanks. Investment, market outlook, and money. I think these terms have been hot favorite of every human being even before they found their place in the dictionary. So thank you very much, Mr. Mohit Ralhan, for accepting our invitation and for sharing your time, experience, and insights with us to give us a sneak peek into the future global trends and also to give us such a detailed past history or back to 100 and 140 years. It was a very interesting discussion and for answering all the questions so well. Thank you very much. And we would also like to thank our sponsors for this evening, TIW Capital Group, and to make this session even more interesting with the lucky draw. Thank you very much. And most importantly, thank you to all our special guests, senior members, and all the chapter members for your significant presence. And a special thank you to our chairman and the managing committee and all the volunteers and event coordinators for their continuous support and active participation in all the chapter events. Thank you very much. Thank you for being a wonderful audience. And please enjoy the rest of your evening. Thank you.
Thank you guys. Please give us 2 minutes. Let's all come together for a group pitch and then we can enjoy the dinner and the networking.